Welcome to this explainer. Man, I am absolutely thrilled you're joining us today because we're about to tackle something that literally impacts every single one of us every single day. Look, whether you like it or not, the second you earn your very first dollar, you're thrust into this massive, highly complex game. It's the game of financial literacy. And you know what the crazy part is? Most of us are forced to play this game without ever being handed the rulebook. But here's the good news. Once you actually understand the mechanics of the board, the stats, and the strategies, you can stop getting played and start winning.
Okay, let's dive right into this game manual. Today, we're going to cover 1. The reality of money, 2. Invisible economic forces, 3. The cost of borrowing, 4. Building wealth and value, and 5. Your ultimate secret weapon.
Section 1. The reality of money. You know, the absolute weirdest part about currency is that, well, it's not actually real. Humans basically invented money just to make trading easier and to keep society somewhat organized. But honestly, there is no more physical legitimacy to a dollar bill than there is to some random stick you'd find out in the woods. The only reason a dollar can buy you a burger and a stick can't is that currency is purely a social construct. It's built entirely on our shared societal belief, our trust that the dollar actually has value. The government prints it, central banks regulate it so it doesn't just turn into monopoly money, and we all just kind of agreed to trade it.
But hey, that brings us to the very first trap of the game. Let's talk about the number $1,456. Imagine you just worked a seriously grueling month, say flipping burgers at McDonald's. You get an email saying you earned $2,000. Awesome, right? But then you log into your bank account and you only see $1,456. Ouch. This is the painful, everyday reality of taxes. Federal income, state, Social Security, Medicare, they all step right up and take their cut. Now, I know it's super easy to get mad about this, but taxes are essentially the cost of civilization. It's the money that builds the roads we drive on and ensures your favorite neighborhood taco truck isn't infested with rats. It's basically a mandatory subscription fee for living in a functioning society.
Okay, so you take your hard-earned post-tax cash and you put it in the bank, right? We all kind of have this mental image of a bank as this giant, impenetrable vault, guarded by a dragon, keeping our specific individual dollar bills locked up safe. But the reality? Totally different. Banks are actually just middlemen. They're like financial matchmakers, connecting the supply of money, which is you, with the demand. And hey, don't worry, while the dragon isn't real, in the US, most bank deposits are government insured up to $250,000, so your money is definitely safe. But it absolutely isn't just sitting there collecting dust. And this brilliantly illustrates exactly what happens to your cash. It's a system known as fractional reserve banking. So, step 1, you deposit $1,000. Step 2, the bank actually only keeps a tiny fraction of it on hand. Then, step 3, they take $900 of your money and lend it out to someone else who, I don't know, really wants to buy a jet ski. The bank makes its profit by charging that jet ski buyer a higher interest rate than they pay you for holding onto your money. And honestly, this system works flawlessly. As long as everyone doesn't show up on the exact same afternoon demanding 100% of their money back, well, unless it's 2008 when people actually did line up and we all saw the entire system crumble.
All right, moving on to Section 2. Invisible economic forces.
First up on the invisible forces list is inflation. Have you ever opened a bag of chips, realized it's mostly just air, checked your receipt, and realized you paid 30% more than you did last year? Yep, that is inflation right there in action. It's not some sudden, crazy explosion of fireworks. It is the slow, quiet erosion of your money's value over time. Your $5 bill is still technically a $5 bill, but man, it buys way fewer instant noodles and a lot less gas than it did 10 years ago.
So what's actually causing this? Well, imagine 2,000 people suddenly have a bunch of extra cash and they all want to buy the exact same $500 TV. The business realizes, wow, everybody wants this thing, so they jack the price up to $800. Boom, that's inflation. It basically happens whenever too much money is chasing too few goods or when supply chains catch a cold, making things way more expensive to produce. To fight this off, the government will usually raise interest rates to make borrowing more expensive, which, kind of forces us to cool off our spending and calms the whole economy down.
But if things cool down a little too much, we smack right into our next invisible force, the recession. This is officially defined as the economy shrinking for at least 2 quarters or 6 months. Think of a booming economy like a massive raging party. Drinks are flowing, everybody's on the dance floor. A recession, that's when the lights flicker, reality hits hard, and suddenly the DJ starts playing sad lo-fi beats about corporate downsizing. Layoffs happen, people stop buying random stuff they don't need, and businesses slash their costs. It is a painful reset for sure, but it is also a completely natural, temporary part of the economic cycle.
Section 3. The cost of borrowing.
The absolutely crucial concept to grasp here is interest, which, simply put, is just money's way of charging rent to exist in someone else's hands. There are two main types you really need to know. Simple interest is super straightforward, it's just a flat fee. Basically, here is a fee, thanks for letting me borrow this. Compound interest, on the other hand, that is wild. It means every single dollar you borrow now has clones. And guess what? Those clones also want rent. If you miss a payment on a credit card charging 20%, your interest literally starts earning its own interest. That is exactly how a simple, innocent $12 burrito can slowly mutate into a $50 financial regret. Now, access to all this borrowed money is gatekept by the shadowy, mysterious algorithm we call your credit score. This little 3-digit number essentially dictates your financial fate, whether you get to buy a house, a decent car, or if you get slapped with a soul-crushing 27% interest rate on a new TV. But listen to me closely here. This number does not measure your wealth. Not at all. It measures your trust. Lenders just want to know if you're actually going to pay them back. The algorithm figures this out using 5 specific metrics: your payment history, how much of your available credit you're currently utilizing, the age of your credit, your mix of different loans, and any new credit applications you've made. The whole score ranges from 300 up to 850. If you are sitting anywhere below a 580, you are basically a walking red flag to lenders. Most folks sit comfortably somewhere between 640 and 790. Hit over 750 and you are literally sparkling with adult credibility. Honestly, your credit score is kind of like a pet dog. If you ignore it and just keep missing payments, it is going to poop all over your life. But if you take care of it, feed it, walk it, someday it might just help you buy a house. And here's the kicker, you can have absolutely zero debt and still have a trash score just because you have no history. Yeah, the game is totally rigged. But by learning these rules, you can rig it right back. Which brings us to the ultimate hack when it comes to borrowing money. It's summarized perfectly by this one thought. Interest is either your worst enemy or your best unpaid employee. The choice is in who's collecting it. When it comes to loans, interest is a terrible slow burn that turns tiny mistakes into massive raging fires. So kill your debt fast. Get rid of it. But in investments, interest is like a magical time bomb that turns small gains into massive life-changing wins. You want to feed that one, let it sit, and watch it work like a cheat code. Which perfectly tees up Section 4, building wealth and value.
The absolute best way to combat inflation so it doesn't just quietly steal your future out from under you is through investing. Investing is simply trading your money for more money, instead of doing what most of us do every single day, which is trading our time for money. It's forcing your cash to get up off the couch and actually go to work for you. And yes, sure, it involves some risk, but you know what the real danger is? Keeping all your money stuffed under a mattress while inflation just eats away at its value day by day. To win this part of the game, you really just need 3 things. You need to be early, you need to be diversified, and you need to be incredibly patient.
But what are you actually buying when you invest? The main vehicles are pretty straightforward. You can buy stocks, which are just tiny little ownership slices of actual companies. You can buy bonds, which is basically you playing the bank and loaning your money to a government or a company in exchange for a reliable return. You can buy funds, which are just big collections of stocks and bonds bundled together so you don't have to stress about picking individual winners. Or you can buy real estate, property that you hope someone else will pay you to live in. The secret here? Wealthy people very rarely win the lottery. They just pick a few of these vehicles and then they give compound growth 30 years to do its magic. Now, what's really interesting here, and to understand where wealth actually comes from, is a simple thought experiment. Imagine you pick up an average rock off the ground. It's just a rock, right? Now imagine that exact same rock is shiny and yellow. Suddenly it's gold. Gold is rarer, for sure, but intrinsically, functionally, it's not actually worth more than the average rock. It is only worth more because human beings place a higher perceived value on it. If you want to make a lot of money in this game, you have to provide value. Steve Jobs created massive value with the iPhone, so millions of people practically threw their cash at him. It's the exact same reason a specialized doctor gets paid so highly, or why Gucci can get away with charging 100 times more for a handbag than Target does. They haven't necessarily changed the materials, they've created perceived value. And finally, Section 5, your ultimate secret weapon. To build that kind of value and to give those investments the space they need to grow, you need the single most important asset in the entire world: time. Most people play the financial game using really simple math. 1 hour of work equals 1 paycheck. They just trade their time directly for money. But the top earners in the world, they realize that time is strictly limited. There's only so much of it. So instead of just trading it away, they leverage their skills and their investments to train their hours to work for them. They completely separate their time from their income. So the crucial point I really want you to take away is this.
Nowhere does time work harder for you than in investing. There is literally no greater force in wealth building. It's not about luck. It's not even about having a massive, crazy salary. It is just time. Wealth isn't built in days, it is built in decades. Money that sits quietly in an investment account multiplies. It starts off slowly, sure, but then it goes faster and faster and faster as compound interest completely takes over. This is exactly why ordinary people with super modest paychecks can retire with 7 figures in the bank. They didn't cheat the system, they just consistently used the system over a very long period of time.
You now know the rules, you know the traps, and you've got the strategies of the financial game. You understand taxes, banks, inflation, and exactly how that shadowy credit score algorithm judges you. But most importantly, you now know that time is your absolute greatest asset. So I'm going to leave you with this one question to think about. You have the time right now. Are you going to sit back and let inflation quietly steal it? Or will you take control, rig the game back in your favor, and let compound interest multiply it? The choice is entirely yours. Thank you so much for joining me on this explainer, and I will catch you on the next one.